Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business with a wink and a smile. Today we're diving into GSR IV Acquisition Corp. Its latest quarterly report, and let me tell you, this one's got more twists and turns than a pretzel factory. So, what is the big deal with GSR IV Acquisition Corp? Well, they are what is called a blank check company, or an acquisition company. Think of them as a special company created for the sole purpose of finding another company to buy or merge with. They themselves don't really operate a business yet. Their whole game is to go out and find one. And right now, they are in that search phase. Let's jump straight into the meat and potatoes, the financial tables. Looking at the balance sheet for the 30th of September 2025, they have a little over $1.8 million in cash. That might sound like a lot, but for a company looking to make a big acquisition, it is actually quite small. What is really interesting is the massive amount they have in their trust account, over $230 million. This is the money they raised from their initial public offering, or IPO, which they set aside specifically for acquiring another business. This trust account is basically a holding pen for the IPO money until they find a company to combine with. It is a common practice for these types of companies to ensure they have the funds ready for a deal and to protect investors. Now look at this number, $9.2 million for deferred underwriting commissions. That is a hefty sum, and it means a significant chunk of money is set aside to be paid to the investment banks that help them go public, but only if they actually manage to complete a business combination. If they don't, well, those commissions might not get paid, which is a good thing for the company if it fails to find a deal. This line here is super important for understanding how these companies work. It shows that almost 23 million shares of their class of stock are considered subject to possible redemption. What this means in simple terms is that the people who bought these shares in the IPO have the right to get their money back, about $10.03 per S-share if the company doesn't find a business to buy within a certain time frame, or if they vote against a proposed deal. This is a key feature for investors in these SPACs you see on the market. Moving on to the income statement for the 3 months ended the 30th of September 2025, they actually reported a net income of about $488,000. Now this isn't from selling products or services because they're not operating a business yet. This income is almost entirely from the interest and dividends earned on that big chunk of money sitting in their trust account. It is essentially found money from parking their IPO funds. Their actual operating expenses, which are called general and administrative expenses, were about $173,000 for the same period. This covers things like office costs, legal fees, and other operational expenses needed to search for a business to acquire. Looking at the changes in their equity, we see a pretty dynamic picture. In 2025, they had a significant increase in their Class A ordinary shares due to the sale of private placement units, which brought in over $6.5 million. This is how they fund their operations and search efforts. This entry here, private placement unit receivable, shows an amount of $5,000. This is a small amount owed to them, likely from the sponsor of the company related to the private placement units. The accumulated deficit is negative, showing they have more expenses and costs than they have generated in profit from their actual business operations. This is totally normal for a company in this early stage. They are burning through cash to find a business. Now let's talk about cash. For the 9 months ended the 30th of September 2025, their net cash used in operating activities was around $325,000. This is pretty much the cash they spent on their day-to-day search operations. They also had about $230 million in cash used for investing activities, which is simply the money they put into that trust account from the IPO. And where did that money come from? You guessed it, $230 million from the gross proceeds of their initial public offering. It is basically moving money from one account to another. We've touched on this, but to reiterate, GSR IV Acquisition Corp is a blank check company. They were formed to merge or acquire another business. As of the 30th of September 2025, they were still in this discovery phase, with all their activity focused on getting ready for and then searching for that acquisition target. They won't make any money from actual business operations until they complete that deal. Their IPO was declared effective on the 2nd of September 2025, and they closed it on the 5th of September 2025. They sold 23 million units, with each unit consisting of one Class A ordinary share and a piece of a right. Each unit was priced at $10, raking in a cool $230 million. On top of that, they had a private placement, selling an additional 655,500 units to their sponsor for another $6.5 million. This This is how they fund their ongoing search and operations. Now, this is a big number, $13.5 million in transaction costs. This includes the fees paid to the underwriters, which is a significant expense for any IPO, especially when the company itself isn't generating revenue yet. This explains the purpose of the trust account. It is a safe place for the IPO money, and it gets released to the company only when they successfully merge with another business. If they don't find a deal within their completion window, the money goes back to the shareholders. This is a bit of a serious note. The report states there is substantial doubt about the company's ability to continue as a going concern if it does not complete a business combination. This is standard language for companies like this. It basically means if they don't find a business to buy soon, they might not be able to keep operating because they'll eventually run out of money and have to give back the IPO funds. Here they lay out the accounting rules they follow. They are following us generally accepted accounting principles, or GAAP, and they are an emerging growth company. This means they get to follow some less strict reporting rules for a while, which is pretty common for newer companies. They're also electing to use extended transition periods for new accounting standards, which just means they can adopt them a bit later. Similar to private companies, they have very little in the way of cash equivalents. Most of their liquid cash is, as we've seen, parked in that trust account. They're talking about how they value their assets. Most of their financial assets, like the money in the trust account, are valued based on what the market says they are worth. They use a 3-tier system. Level 1 is based on public stock prices, Level 2 on similar market data, and Level 3 on their own estimates when market data isn't available. In this case, the investments in the trust are likely Level 1 or 2, meaning they have pretty clear valuations. Because they are incorporated in the Cayman Islands, and they are not yet operating a business that generates income, they currently have no income tax liabilities. This is a common setup for international holding companies. This section is crucial for understanding investor rights. It confirms that those class of shares have redemption rights. This means shareholders can get their money back under certain conditions, and this is why these shares are classified as temporary equity on the balance sheet, separate from permanent equity. Here we see the earnings per S-share. For the redeemable shares, the earnings per S-share are positive, but this is calculated based on the interest earned in the trust, not actual business operations. For the non-redeemable shares, which are mostly held by the founders and sponsor, the earnings per share are also positive for the period, again driven by trust account interest. This is where they detail the IPO again. 23 million units were sold at $10 each, raising $230 million. Each unit came with one class of share and a fraction of a right. These rights become valuable if a business combination is successful. This details the private placement that happened at the same time as the IPO. The sponsor bought 655,500 units at $10 each, bringing in another $6.5 million. These private placement units come with their own set of shares and rights. This section is all about transactions with people or entities connected to the company. Like the sponsor, they issued 5.75 million Class B shares called founder shares to the sponsor for a mere $25,000. These shares usually convert to class of shares upon a business combination and often come with certain voting rights. They also have an administrative services agreement where they pay the sponsor a monthly fee for office space and support. The sponsor also provided a loan of up to $300,000, which was non-interest bearing and due very soon after the IPO. It looks like as of the 30th of September 2025, this loan was no longer outstanding. This shows costs that the sponsor paid on behalf of the company. These amounts are usually short-term and paid back once the company has funds, like after an IPO. This covers things the company is committed to or might be liable for. They have registration rights that allow certain shareholders to demand their shares be registered for sale. Also, the underwriting agreement lays out the cash and deferred commissions. This confirms the underwriters' fees. They received cash fees upon the IPO and have deferred commissions that will be paid out of the trust account if a business combination is completed. This is a breakdown of the company's stock. They are authorized to issue preference shares, class of shares, and Class B shares. The Class B shares, the founder shares, have special voting rights before a business combination. The key takeaway here is how the class of shares are presented, with a large portion subject to redemption. This explains what the rights are. They are essentially the warrant to buy a class of share in the future, typically upon a successful business combination. If the company fails to find a deal, these rights expire worthless. This reiterates how they value their assets, particularly those in the trust account. They primarily use observable market data, which means their valuations are pretty straightforward and not based on complex internal models. Since this is an acquisition company that hasn't started its main business operations yet, it only has one operating segment, the search for a business combination. Their chief operating decision maker, in this case the co-chief executive officers, review the overall financial performance to make decisions. This section usually details any significant events that happened after the reporting period, but before the report was filed. In this case, they state they didn't identify any such events that would require adjustment or disclosure. This is the management's own explanation of what is going on. They reiterate that they are a blank check company and their main goal is to find a business combination. They'll make money from interest on their trust account funds until they merge. They restate the details of the IPO and private placement, including the dates and amounts raised. This is standard reporting to make sure all the facts are clear. This section discusses their cash situation. They have a limited amount of cash outside the trust account for their operations, and they expect to use those funds to cover expenses related to finding and closing a business combination. They acknowledge they may need additional financing. They repeat the going concern warning, which is important. It signals that if they don't find a target and complete a deal within their time frame, there is a real risk they won't be able to continue operating. Management explains their net income is primarily from trust account interest, not from business activities. They had a net income for the period because of this trust account interest, but if you look past that, they are simply spending money to find a deal. This is a rundown of their commitments, like the administrative services agreement with the sponsor, the promissory note, and any working capital loans. They are signaling that these are all manageable within their current structure. As a smaller reporting company, they are exempt from providing detailed market risk disclosures. This means they don't have to go into a lot of depth about how things like interest rate changes or currency fluctuations might affect them. This is a critical section. Management admits that their disclosure controls and procedures were not effective at a reasonable assurance level. They cite inadequate segregation of duties and insufficient written policies for accounting, and financial reporting. This is a red flag, indicating potential weaknesses in their internal processes. It means there is a higher risk of errors slipping through the cracks. This part contains miscellaneous information. They report no current legal proceedings. They refer back to their prospectus for risk factors, stating there have been no material changes. This means the risks associated with their business, mainly the risk of not finding a business to acquire, haven't changed significantly. This details the IPO and private placement again, and how the proceeds were used, largely placed into the trust account. This is just a list of all the legal documents and agreements that are part of this filing. It includes things like the underwriting agreement, articles of association, and various other contracts that govern the company's operations and its relationship with the sponsor and underwriters. So, what is the story here? GSR IV Accession Corp is a classic SPAC in the crucial but often nerve-wracking phase of searching for its target. They've successfully raised a significant amount of money through their IPO, which is sitting safely in a trust account. However, like many SPACs, their financial health is entirely dependent on finding and successfully completing a business combination. The report highlights operational expenses that are normal for this type of company, but the big takeaway is the admission of not effective disclosure controls. This could mean internal processes need tidying up to prevent errors. The clock is ticking on their completion window, and investors will be watching closely to see if they can strike a deal that justifies the significant capital they've raised. It is a high-stakes game of finding the right dance partner before the music stops. Alright, that is our deep dive into GSR IV Accession Corp. Its latest quarterly report. What do you think about their chances of finding a business to acquire? Are you a fan of SPACs, or do you see them as too risky? Drop your thoughts in the comments below. If learning to decode these corporate documents helps you make better investment decisions, hit that like button and subscribe for more. And don't forget to join our Discord community linked in the description for even more access and discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.